Hi, everybody. Tim Knight here. This is July 19th, 2010, Monday afternoon. IBM just reported their earnings, and it was just minutes ago. The stock itself was down 3.2% after hours. That's pretty cool, actually. Last week we had some earnings that were just knocked out of the park. Intel comes to mind, as as well as the putting in quotes good news from BP and Goldman Sachs. And in those instances, in spite of a big after hours rally, like 7%, they were all quite fadeable. In this instance, we don't even have that to fight. It's down right from the get go. So it'd be interesting to see how this plays out. If we had a pop and drop with the others, will this be something different? I don't think so. Anyway, I wanted to talk just about indexes a bit here. The reason I'm not focusing much on individual stocks these days is because so many of the items that I'm short have kind of similar looking patterns anyway, and usually when I focus on individual stuff, it's because it's out of the ordinary. And because I'm so short these days, it gets a little monotonous for me to just keep pointing out things to short. I will say the one and only long position I've got, which I definitely have had mixed results with in the past, is TBT. I did some day trades on this today, all of them profitable. This thing, as you can see, has been downtrending badly for most of the year, so I've had a lot of bad experiences with this. But it's a bit of a hedge for me against all these shorts, because if the market, for whatever reason, does get strong, this should be quite firm, and I'd like to have something out there for that eventuality. But that's my one long. The others, I've got 242 straight up equity short positions. The larger ones, and I'll just use my little. Oh, wait a second. Getting a little fumble finger here. Excuse me. Uncheck all. Okay. Sorry. What I was gonna do is apply the label filters, and I do this several times a day actually, and I say include only the ETFs, and that way it shows, in this instance I've got just 5 ETFs, which tend to be my larger positions that are in my short. So of the 242 shorts, 5 of them are ETFs, and the other 237 are just stocks. So here's the biggest one, FXE, which is my kind of Euro Forex short play. Here's another one, HYG, which is the high yield corporate bonds. Real estate I shorted today. This is an interesting, it's kind of oscillating between this kind of very interesting kind of arrowhead shape right here, kind of cool. But it is still broken these two trend lines, and I felt that today's little pop represented a pretty good price. Moo, which I think Hun has mentioned. I don't know if he's long or short. I'm very short this thing right now. I think this is a very nice, pretty safe short position. And then right near the close today, I shorted the cubes. Pretty good size position. They're down after hours 0.6%, which is pretty nice. But that kind of leads me to the subject of this post, which I called, what was it? Big versus little or something like that. The point I'm trying to make is that there are kind of two ways, I think, if you're a bear, to play this market. One way is to try, and I'll make this a line graph to make it a little more plain, to try to take advantage of, and we'll hide the drawn objects, of these oscillations here. Because as you can see, we've had 1, 2, 3, 4 big drops and pops. If a person were able to take advantage bidirectionally of that, that would be sensational and sensationally profitable. I have been pretty much more of the hold on kind of guy, and that makes the drops nice, but it makes the pops slightly expensive, because you're bound to get stopped out of at least a portion of your positions at a loss and pay commissions at the same time. and kind of nerve-wracking because, these things are like 8, 9, 10% pops each. So on the whole, we've got what every bear wants to see, which is lower lows and lower highs. I just am not trying to play those swings, and why not? The reason is that I do believe the day will come, and it's impossible to say when instead of this wiggly nonsense, that we have a sustained drop. And what I don't want to do is just have covered all my shorts and then watch the rug get pulled out from under the market. And so the small I'm referring to is these small little wavelets here that are going on all the time. And the large is more along, this kind of thing, which is a multi-week or, heavens, could it be multi-month drop. Let's take a look, for example, at the S&P. Same sort of phenomena going on here. And what can be exasperating about this, and let's go back to the 07-08 bear market, is that you can have for a while what looks to be a very handsome topping pattern, which I'm kind of wiggling over right here, and it just kind of monkeys around. I mean, it cracked it and messed around there about 1250, and this 200-point rally from there. That can be disheartening and expensive for a bear. Now, as we know, because we have the benefit of hindsight, when it finally did break, it was a sustained bear market where it made sense to just kind of lean back in your chair, cross your arms, and watch the fun. And it wouldn't have made much sense at all to try to be jumping in and out because it's just too risky to try to be jumping in and out of a market which is trending strongly in a specific direction. Just like it wouldn't have made sense in a market like this to play the bearish side. There were little, probably also 10% or so drops along the way, which would have been profitable for a bear. But you would have gotten smacked unless you were really, really nimble and had some really near flawless technical indicators. So the medium/long-term trend was up in this case, and that's the way to play it. So by way of this example, I'm really trying to get across the fact that I am continuing to take my kind of bottoms-up approach to investing with a lot of very multitudinous small positions, each of which will be stopped out by their own devices. But that's why it's philosophically aligned with, but very difficult for me to kind of hold tight through these mini rallies we're getting. At the moment, we're not having a mini rally. We're on the other side of that. And if we go through the same kind of nonsense again, maybe this thing will kind of peter out around the psychologically important 1,000 level, and we'll get more monkey business to the upside for yet another lower low and lower high, just a big fat drag. But as I continue to say, I believe at some point, August, September, at some point, this big honkin' field of space here, dropping down to 875, will be traversed. And I don't know what it would take to create such a thing. I don't know if we'll get there 1% per day or have 10% day or who knows how. But I don't intend to really cover everything until such time as we are at this kind of level. And as I've said, I think once we are there, then for the next year, it's probably going to be a little bit weird to write this blog because I'm going to be taking off my bearish cap for about a year. It's going to be a much more muddled market, I think, for a little while. Because returning, as always, to my analogy here, to my analog, I think that we'll be experiencing this kind of rise for a while, which I'd like to try to benefit from. And maybe in 2011, we'll get this kind of 2-year true bear. That's it. Adios. Good night.